I first want to begin talking to you about the fact that when you took over in Feb 2013, when you joined Morgan Stanley, the world has changed since then. Though slowdown risks persist, there are geographies that are doing well. How are you assessing the world economy at large right now?
Well, it's interesting. It's my actual third time at Morgan Stanley, having spent a little time in government and just returned. And I think that the reality is, I think the economy is like a tale of two countries in which, literally and figuratively, you have the United States, which growth is doing quite well. You've had, almost 50-some months of continuous growth. You have unemployment going from 9% to 6%. You got the stock market obviously going from 7,000 to almost 18,000. And unemployment and real wage growth is happening in the United States. So I actually am very bullish on the U.S. economy. I think the economy is growing quite nicely. It still has some middle-class wages need to go up, but I think generally the view, at least from Morgan Stanley's perspective, we feel very good about what happened in 2014, and we feel very confident on where we stand and where as the U.S. economy stands going into 2015.
There's enough empirical evidence to support your optimism and your confidence in the U.S. economy, but the world believes that the U.S. has been the single engine of growth pre-crisis. Do you believe that situation can continue? Is U.S. dominant enough to do that, even though pockets of trouble exist in Europe, China, and other parts of the world?
Well, I think, listen, the United States plays a very big role. Obviously, we're a massive trade partner. We're a massive exporter. We have the capacity to be an engine, but we can't do this alone. And obviously why Secretary Liu, the Treasury Secretary, encouraged and with a lot of force for the European, certainly Mr. Draghi and the ECB to take some fairly drastic measures to try to boost the economy. No, the United States cannot do it alone. Listen, China's growth at 6.5%, 7%, I feel pretty confident about China's growth and China's growth opportunities. And if you look around the economy, again, I think it is some countries are growing slower than others, some are growing fast, but I do think the United States is a fairly clear measurement of what the possibilities are for growth around the world.
The big difference, however, between the U.S. and what Mr. Draghi can do really is the fractious polity that one does see in Europe. How effective do you then think monetary stimulus can be for a region where we've got the bigger dominant players like Germany not really, buying the whole argument of bailing out countries like Greece, and Greece continues to be politically volatile with no fiscal measures to fix its house?
Listen, I think, again, like anything, you have 17 countries, each have different economic situations. Greece is on one side of the spectrum, Germany is on another. But you have a lot of economies, in the UK in particular, that show strength. My belief is that part of this is a momentum play. Part of this is creating the momentum in the markets that monetary policy will begin in helping kickstart some of the economies and start kicking the economies in some of the countries that are hurting. Again, I think it is very hard to do to some extent, but I think Draghi is focused on using the quantitative easing measures that he has, and I think there's been general buy-in among the EU partners in which to show something fairly aggressive.
Fair point indeed. Let's move from Draghi on to China. There are people around the world who are beginning to lose sleep over what's really happening in our neighbor, at least. Is there at one level the whole risk in China really being talked down, really not being given the importance there is? A 7% growth in China, many people believe it has to switch to the consumer-led growth model. How do you assess in China? Do you believe there are fault lines that exist in that economy?
No, I'm quite bullish on China. And I think the reality is you've got President Xi, who basically laid out a very clear vision about the focus on corruption and opening markets, which has been a clear message to the people of China that he understands the concerns. He understands, too, that it needs to be a consumer-driven market. And if you look at the most recent numbers, it's actually moving to that consumer-driven economy. Again, not where it needs to be, but it's moving quite quickly. He basically said this is the new normal. Right? That he wants a slower growth, but a solid growth based upon consumer spending, not on extraordinary government spending. So I I'm optimistic on it. I think, listen, is it 6.5? Is it 7? Is it 7.5? I'm not smart enough to determine by 100 basis points what will the growth is. But I think for a company like Morgan Stanley, I think we're very bullish on the opportunities there. I think the President Xi is saying the right things. I think that the economy, the markets are reacting to that. So I'm actually quite bullish on China and where we sit today vis-a-vis the markets.
You don't obviously lose sleep to the last decimal point, a fair thing to do. But let's talk about India. President Xi is saying the right things, and so is Prime Minister Modi. There seems to be this whole euphoria about India. IMF and World Bank have both said that India can match up to China's growth rate by fiscal year 2016 or 17. Are you a believer in India? Do you believe there are right noises being made at least? And do you now expect action to follow?
Well, first of all, as you know, there's a reason why President Obama is going back to India. I think he's the first American president to go twice in his term. There's two reasons. One, economics. You have almost 1.3 billion Indians, which are an enormous population, as you know. You have a third of the country under age of 30 years old. That's a huge market. You have U.S. companies wanting to break into the market. So you have an economic engine there that is massively important. Huge infrastructure needs, need I tell you. So huge investment. So there's an opportunity. Then look at the security piece. There is an enormous importance. India plays an enormous security role in the region vis-a-vis the confidence in the region, the relationship with Pakistan and Afghanistan. It begins and ends in many cases with the stability of the Indian government. And I just end by saying that Prime Minister Modi has had a very good start. As you know, he came to the United States a couple months ago, filled Madison Square Garden.
That's right.
There's an excitement there both in the United States and India. Obviously, that comes with a lot of expectations, and that's important to do. But I think if you will have anything to do with business, and you look at the demographics of India, you look at the numbers in India, you can't not be bullish. We'll now have to see if things can get fulfilled.
Are the big boys of Wall Street, I'm going to take a cue from the last bit you said, whether expectations and results can get fulfilled. Are the big boys of Wall Street, including yourselves, buying into the sales pitch that India is making as far as the reform measure is concerned, or do you believe our markets still need to be freer? Or are you giving the government some advantage that this is a gradual process? We will see it happen in the course of the next 5 years, at least the term of this government.
Well, Morgan Stanley has been there for 25 years. So we've been in India for a long time. We've had offices there. We've had employees there. So we've been always bullish on India. Listen, miracles don't happen overnight, so we have to be careful that expectations don't get ahead of reality, right? You have an education issue there, you have a poverty issue there, you have a real infrastructure needs there. So you have real needs. I don't want to sugarcoat that, but you now have a government who understands that. You have a government who's convinced of that. So I think, listen, whatever the big boys on Wall Street, I don't know if we could put ourselves in that category. I guess we do. We're bullish on the opportunity of India. Obviously, only time will tell if those wishes become realities, but I think we're pretty happy about the direction the country is moving in.
Fair point indeed. Banks are adjusting themselves to new regulations, and which is why, a lot of banks are actually downsizing their whole trading business, expanding advisory, expanding asset management. Do you believe the time has come when banks are going to look at not leveraging market volatility? And is the new normal really to align yourselves to less volatile, more measured markets across the world?
Well, we at Morgan Stanley, that's kind of our sweet spot, right? As you know, we have created a business model that has a premier investment bank, a sales and trading business, a very strong fixed income and equity business. And we married that to a premier investment bank, which has great advisory business, a kind of a number one franchise investment bank. And then we've married that to a retail business to be direct to customers. That's right. And the combination of those two is what the market is looking for. Not that we're smarter than everyone else, but we've positioned ourselves in a place where I think the combination of those two businesses is what the market wants. Listen, we also are in the risk-taking business. We'll take appropriate risk, but we're also into making sure we understand what our customers want and the regulations that look at our business. So we happen to be feeling very good about the sweet spot we're in today. And I think, listen, we live in a world of regulation. We live in the world of Dodd-Frank. We'll manage through those regulations.
That's right.
That's the rules of the road, and that we'll manage around those.
2014 was the year of equities across the world. Equity markets rallied. We've seen a lot of money flow into bonds. There has been a rally of sort in the bond market as well. Is it time that the world will start taking refuge in instruments like these?
Yeah, listen, I think, markets go up and markets go down, as I like to say. Listen, the equity markets have had a bull run for the last 3 years. There's no question there is, and they've been cycled out of areas like commodities, gold, real solid commodity futures, which have had a pretty dramatic downfall, or certainly a sell-off. I think you're going to see a secular move back. I think, listen, I don't know if oil can stay below $50 forever. My assumption is probably not. But I think the equities market, certainly in the U.S., have more to run, more space to run. I think our people are pretty optimistic about that. And then I look at some of the emerging markets. I think have, again, opportunities there. But yes, I think there's an opportunity for both the bond market and the equity market. Again, like everything else, it's a quarter by quarter, and depending upon what happens with interest rates, I think will determine where the equity markets tend to go.
You've actually prompted me to my next question, talking about interest rates. When realistically do you expect the Fed to act on interest rates? Your internal reports seem to suggest it is not going to happen before middle of 2015. Is that a consensus that's building up, or could we actually see that decision being deferred because inflation hasn't really risen as was being expected to?
I think it's pretty hard for any of us to second guess what Janet Yellen may do. Listen, I think the economy is improving, which is good news. I think the reality is every indicator in the United States has an up arrow. Listen, we have more to do for getting middle income, the economy or the economics for middle income Americans up. But I think all of that is directionally. I think most of the people fundamentally believe at some point interest rates are going to go up. It's good for the market. It's good for the economy. Will it be in the third quarter or the fourth quarter? I have no idea. If I knew, I wouldn't be talking to you. I'd be trading on it. But I think generally, I think there's a general sense in the marketplace that the direction is to move rates up over the short term, and when that will be. Again, I don't know, year-end, middle of the year. I think they're looking at the markets as you and I are.
I have a last question to ask of you. We did see the Swiss bank and do to its currency or what it did. This obviously amounts to a huge crisis that's mounting up, and that's deflationary downdraft that the world is seeing. It's not really been talked about as much as it should be, perhaps. We've seen what deflation has done to Japan. Is that something that the world is still not losing sleep over and will just rise to that shock?
Well, again, I think it's like all this. I think you have to balance between growth and the needs to stimulate. There's issues around deflation and, in fact, inflation. So I think the actions they took here, I'm not going to second guess or question. They basically made some decisions based upon their own economic situation, and quite frankly, the markets will react to it, and they'll either benefit or not. But I go back to this. I'm very optimistic. I'm generally optimistic about the U.S. markets. I'm generally optimistic about the European markets once they can, address some of the economic issues using the monetary policies that are available to them. So I'm a generally optimistic individual. So I think, again, you're going to have these backs and forth vis-a-vis the debates between deflation, stimulus, rates. But that's okay. That's what makes markets.
This one needs many more optimistic souls like yourselves. Thanks very much for speaking to us. Have a great trip in Davos.
Thank you.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.